Welcome, everyone, to the Investing Mastermind Podcast. I'm Michelle Markey.
And I'm Sina Lunhold.
And today we wanted to talk about some of our favorite investors who we consider to be the real masterminds of investing, Warren Buffett and Charlie Munger. And so we'll tell you a little bit about how Warren Buffett got into the kind of investing that he does. And many people in the mainstream consider the style of how Warren Buffett invests as value investing. But we'll tease that out a little bit more and give you some background information so you can better understand how Warren Buffett and his business partner at Berkshire Hathaway, Charlie Munger, really invest. And so with that, Sina, if you'd like to open up what we're talking about today.
Yeah, thank you so much, Michelle. Also, it's like, at least for some years, value investing kind of had a bad name because there was so much growth in the market and prosperity in the market. But this is really a strategy that you can use regardless of market conditions. The strategy of Buffett that we're going to talk about, even though it started with value investing, his method has really grown through the years, and that's what we really wanted to share a lot about right now. But also, as we believe he's one of the biggest masterminds of investing, we thought it was super important to just, share a little bit about his journey, because it might resonate with you. It definitely resonates with me, what he has been through. So Buffett, as 11 years old, he bought his first stock. It was actually a quite young age. When I was 11, I definitely did not think about stocks. I don't know about you, Michelle. Did you think about that kind of thing? No. So back then, he bought his first shares. He was pretty lucky. They went up, they went down, and then they went up again. And so for him in the very beginning, he really thought that the concept of the stock market was to pick stocks that would go up. What he did in the very beginning was what is called technical analysis. It's a trading strategy where you, for example, look for head and shoulder formation. So you see different things in the stock chart of the stocks. You try to draw some lines in there. He also did technical indicators, which is a really strange concept and quite complicated. Yet a lot of people are doing that, where you can put in a technical indicator, an average, and then that will sort of give you a prediction of whether or not you should invest in this stock. And that's actually how he was investing in the very beginning. And he actually really, really liked that. He's mentioned that he loved that kind of stuff, made the drawings and look at the technical indicators, but he found out that it was the wrong stuff he was looking at. And Michelle, maybe you want to mention what was it that just completely changed his life?
Yeah, and as much as Buffett had so much fun doing the technical analysis and charting, and he did that throughout most of his teenage years. And like you said, when he bought a few shares of City Services Preferred, he did pretty okay with those in the end. And yet he felt a little bit disappointed in his own stock investing performance, that by the time he was around 20 years old, he came across who would become his mentor and teacher, Benjamin Graham, a professor at Columbia University, who had written some seminal books on investing, including Security Analysis and then Intelligent Investor. And it's Intelligent Investor that Warren Buffett came across at that really influential age where you can be influenced by ways of carrying yourself, that this book, Intelligent Investor, really transformed how Warren Buffett saw investing. And as soon as he read a paragraph in that book it was in chapter 8, he said at the annual meeting this year, it really changed fundamentally how he approached investing. To, instead of trying to predict where stock prices would be and doing a lot of the charting and technical analysis, he realized he should think about investing in a different way, as in you're owning a business. So even if you only buy one share of a stock, you are considered a business owner in that business or company. And that really shifted how he began to evaluate companies and businesses in which he was interested in investing. So when he found that book and learned about this way to invest, he also understood that the way that Benjamin Graham invested was sort of this like value investing style of investing, where Benjamin Graham was all about finding companies that sort of had a last puff of investing, where they might only have a little bit more cash flow to squeeze out. And that's why it's called cigar butt investing. Because I guess, if in a sort of nasty way, if you walk around the street and you find a cigar or a cigarette butt, you could maybe get one puff out of it and then you discard it. So in a similar way, if Benjamin Graham came across hundreds of companies that maybe had some cash flow you could get out of it and liquidate the assets, then he would just invest in them mostly for that and get the value out of those companies and then kind of ditch them later. So for a while, that influenced Buffett to invest exactly the same way. And so Buffett did that when he bothered Benjamin Graham enough to allow him to work for him, because he had taken his classes at Columbia, and then he really wanted to work with Benjamin Graham after he finished his MBA. And then he got to work for his star mentor and idol that he really admired. And it was an incredible experience for Buffett in his early 20s to be able to work for his idol for a few years. And then he eventually struck out on his own in his mid-20s and invited people from his neighborhood and family members into his own Buffett limited partnerships. And he did that for a while. And then, Sina, do you want to talk about what he did next?
Yeah, sure. Because this is where we really, we've really seen Buffett shine. He came to know a guy named Charlie Munger. And Warren Buffett is a person that a lot of people in the world, they've heard his name, might not necessarily know what he's all about, but he is the most successful investor of all times. For 60 years, he's done amazing, and no one else can have done the same. And it was actually after he met Charlie Munger. Charlie Munger is his business partner. They are around the same age. Charlie is slightly older than Buffett. Buffett was 29 when he met Charlie. I believe Charlie was 36 at the time. And they met through friends in Omaha, Nebraska, where Buffett was living. Charlie Munger lived out in California. And they met through mutual friends who brought them together, because the friends thought that these two men were super similar. And at that dinner party, they couldn't stop talking to each other, and they just immediately formed a deep bond. Charlie Munger was a lawyer living out in Los Angeles, had done some real estate as well as stock market investing. It was really when these two came together that they became masterminds, the lawyer and the stock investor. And moving away from the cigar butt investing that, Michelle, you mentioned, because Charlie Munger brought in a new concept about, okay, so why not, instead of buying these companies that are, not that great of a quality, why not buy a really high quality at a very, very low price? What Benjamin Graham mentioned in The Intelligent Investor is that price and value is not the same. So the price that you pay for a stock is, not the same as the value of the business that you're buying into. It's two completely different concepts. Charlie Munger definitely agreed on that, but instead of buying companies that only had a few puffs left, instead buy high quality at a fair price instead of buying low quality at a okay price. Michelle, you have actually something you just want to add to this.
Yeah, and just a little tidbit is that, interestingly enough, they hadn't met until, they're well-grown adults into their professional careers, but they were actually both from Omaha, Nebraska, and Charlie had actually worked in Warren Buffett's grandfather's grocery store as a stock boy and, stocking the shelves. And I think Buffett also helped out at that grocery store when he was also a kid, but they never crossed paths at that time. So it was just funny how even though they were both from the same city, they never got to meet until, they're in their late 20s and mid 30s. And then that's when, the magic started. So it's incredible how, the world can be really small sometimes. And then they ended up becoming the best of friends. And so, yeah, it was interesting how Benjamin Graham was the foundation, and Warren Buffett is always singing the praises of Benjamin Graham as giving him that foundational knowledge. And then Charlie Munger helped Buffett take it to the next level, because had Charlie Munger not really been around, or didn't influence Buffett to focus on high quality businesses, not ones that were about to go out of business, maybe Buffett might not have become as respected or as well known. Because another little tidbit is that Benjamin Graham actually lost a lot of money throughout his investing career. Like, he made it up, like throughout the Great Depression. A lot of his investment management fund that he was doing kind of went almost close to zero, and then he was able to get back. And it was, probably nerve-wracking at the time, I can only imagine. But in spite of, some of the ups and downs that Ben Graham had, he kind of just ended up being like a really good educator of this style of investing, of thinking about how to value businesses in a fundamental kind of way. But his own investing track record didn't get to be as great as Warren Buffett. So yeah, that was just all I wanted to add. And please continue.
Yeah, it's great that you touch upon Graham again, because one of the cigar butts inspired by Graham that Warren actually bought into was a company that was called Berkshire Hathaway. It was a textile mill in New England. And what he saw was that the management was buying back shares. And that meant that, thinking as an owner, that his share of the business would grow bigger and bigger. It turns out Berkshire Hathaway it's not a fantastic business. The textile industry is booming in Asia, and so the New England textile mill is really struggling. What I think is absolutely amazing is that Warren Buffett decides, well, it's not a fun decision necessarily to close down the mill and have to let go of all the people, but he decides that Berkshire Hathaway, his big failure, his major failure, the business is not doing great. It's really failing. And he turns that around and makes Berkshire Hathaway one of the most successful conglomerates that we have today. So he really takes this fail he made and just turns it around. I find that incredibly inspirational. Then he meets Charlie, and that is great, because now he actually has a lawyer in his team, and not only a lawyer, but a really brilliant lawyer that he can also ping ideas off. And it is so important to have someone who actually can give that type of legal advice when you're buying businesses, as Warren does. So I think, the two of them, one being a lawyer and one being a great business person, has just been this perfect combination of people, and really created that mastermind.
Yeah, and to add to what you were saying about how Charlie likely influenced some of Warren Buffett's decision making when they realized that the Berkshire and Hathaway textile mill businesses in New England were maybe not able to keep up as well with the overseas competition. And I think where they realized that they needed to reallocate capital was, in spite of the people of Berkshire Hathaway doing all the great work that they did, no matter how much they kept pouring into the business, it was not yielding additional returns that they expected. Like, they were losing money instead of making money. And so that I imagine Charlie influenced Warren to think, how can we better allocate the capital so that we can actually make better money than just kind of putting it into a money pit where they know that this business is starting to fail and it was no one's fault, but you just have to be able to adapt to a changing business environment. And I think from Charlie Munger, he has this sort of well read wisdom where he is very multidisciplinary. Like he learned a lot of subjects after he got out of the military when he went to his university, and then when in his training to become a lawyer, he gained a lot of understanding of different subjects. So I think in general, there was, I'm sure, a lot that Charlie influenced Warren in his thinking. And Warren Buffett already was also really well read and was an avid reader of the news. And he would go through a lot of companies in Value Line or similar books of going from A to Z, looking at what different companies are out there and, where there could be some undervalued businesses. So if he found a business that had way more cash on its books than maybe it was trading in the market, maybe he realized that some of those are actually really good businesses. And if he invests in them, he can also get the capital from those companies. That so if they are producing cash flow, he can repurpose those funds and put it in more investments. So it ended up being somewhat of a snowball effect of being able to reallocate the cash, that if the business doesn't need it itself, you can put it into something else and it will help you generate more money. And I think that became the magic of Berkshire Hathaway, is adapting to the changing business environment and reallocating the capital in a smarter way.
Yeah, absolutely. And much of his later success was really, buying those undervalued businesses, and we'll dive deeper into some of these topics as the podcast progress. So make sure to continue to following us and listen in as we dive deeper into some of these concepts that we're mentioning here. But what happens after these two people meet is that they really start looking into the difference between a healthy business and a sickly business, looking into some of the key financials that makes a healthy business versus a sickly business, and trying to find the businesses that are healthy, but then are selling in the stock market at a brilliant price that is actually undervalued compared to the real value of that company. What is also quite lucky is that there is a downturn in the market. So stock prices, you could say, go on sale. People are selling their stocks. A lot of these quality companies are now selling at a discount, you could say. Berkshire Hathaway scoops up businesses in the 60s and in the 70s where they, just really, while the general market is not super strong, that's when Berkshire Hathaway really grows to be a super strong business. Because what happens with healthy companies is that over time, as the market sort of regains some positivity and people, the general public, starts buying into stocks again, then is the healthy businesses that are really, really doing well. And that's been the strategy, and that's the strategy that Michelle and I are also following, and why we find that Warren Buffett and Charlie Munger are incredibly important to follow and learn from. And everything that Warren Buffett has invested in through Berkshire Hathaway is actually public information. You can read his annual letters, and you can read why he invested in those companies and what were some thoughts around it. The language can be a little bit difficult to understand, and that's why Michelle and I are trying to sort of translate it into words that we use today. Michelle, you have something to add?
Yeah. And yeah, I know, like, I've been reading through some of the Warren Buffett annual letters going back to the 50s, 60s, when it was the Buffett Limited Partnership. And those were a lot shorter than what they became. They became these like 20-page essays by the time it evolved into the more Berkshire Hathaway letters. And there's so much rich information on there. And I don't always know or understand everything that Buffett is saying, but then I'll look it up in Google a little bit more of like what did Warren Buffett mean, and try to see if other people have explained it a little bit more, because as well as Buffett explains a lot of investing concepts, sometimes, it just helps if you have another perspective explaining it. And, one example I wanted to mention of what you were saying about investing in healthy businesses in spite of a struggling economy was how Berkshire Hathaway invested in the Washington Post company, which has the Washington Post newspaper. And in that asset, Warren Buffett realized, and he was really into newspaper businesses, and they invested in the Buffalo News before they had to sell that business. But, back in the day, 50 years ago, newspapers were super strong, and they're like the original version of, say, Google or Facebook, of how you can get your news, and they can sell ads. So before, in those days, they would have a lot of newspaper print that you have a mix of the actual content of news plus your advertisements. So when you could sell advertisements, you made money that way in a newspaper business. And that's what Warren Buffett recognized. And he pounced on Washington Post when that company went on sale in the stock market, and he got it at a really good deal. And he actually talked about the Washington Post in the 1997 Berkshire Hathaway annual meeting, where he countered what a lot of people in academia define as risk. And a lot of people think that if a stock's price is going up and down a lot, it's more volatile and therefore more risky. But to Warren Buffett, he saw that as an opportunity to get really in on a wonderful, healthy business like the Washington Post in the 70s. And, as the stock price went down, they would buy more Washington Post and not less.
Which
So,
is counterintuitive, right? Like most people, when the stock market goes down, they might panic sell. Sorry for interrupting, but just to, highlight that point.
yeah, exactly. So that's exactly right, Sina. The whole point is you should want to buy a wonderful business when its price is lower. Just like I like using this example of when you go to a grocery store, are you happier or not happy when the price of some things you might want to buy are on sale? So I think generally, if something is on sale at the grocery store, let's say it's laundry detergent, you're happier when you can buy that laundry detergent at a cheaper price and not at a more expensive price. And that's how we should also think of when we're buying stocks in the stock market, is as long as it's a great company and they're not going out of business, and they haven't lost all of their competitive advantages, which we'll talk more about in a future episode, then maybe they'll be able to recover after the economy also recovers. Like if there's a recession and rampant inflation like there was in the 70s and like what we're seeing now, maybe these amazing businesses will do well again. So now that they're being knocked down could be an opportunity to invest. And then there's another scenario where maybe the company is going through its own event. Like there could have been some issues that the company is experiencing, and then they recover from that. And I know, Sina, do you want to add to that?
Yeah, exactly. Because that's, you're talking about that an event could happen. So one business falls versus right now with the whole market is going down. And that's actually also one of the companies back in the day that Warren Buffett also was super successful with was American Express. And American Express was involved in a huge oil scandal. They weren't necessarily a part of it, but they were heavily involved in a company where the owner really defrauded a lot of people with that oil business. And it's a funny story that I won't go too much into detail with, but the whole point was that American Express stock really fell like an elevator. The stock price fell. The company was still in a great shape, but people really lost faith in the stock because they were involved in this scandal with I don't remember, but it was some kind of sunflower seed oil or something like that. And that's an example of an event where a business, where people might be selling the stock because it's involved in a scandal. However, the business is still a healthy business, and the business did not necessarily cause that scandal, but was, just involved in something. With that story about Charlie Munger and Warren Buffett, I think it's time to wrap up around now.
Yeah, I mean, I think we covered our areas of introducing how Warren Buffett and Charlie Munger came into this style of investing and how they've evolved over time. And this is basically their bread and butter. A lot of the investing decisions they made in the 70s and 80s became the foundation of what Berkshire Hathaway is today. And of course, they expanded into many more businesses, and they're a very diversified conglomerate. But in learning about how Buffett and Munger started out their investing journeys, we hope that you found this educational background helpful, and that it can also give you some inspiration if you come across some books or investors that maybe can tip you off into a certain way of investing that makes sense to you.
Yeah, so thank you so much for listening in. We really appreciate that you're here and listening to the podcast. If you have any feedback for us, please do feel free to reach out, or any questions that we can help you answer.
Yes,
With that, thank you so much, and see you next Tuesday.
Yeah, take care, everyone.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts, so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.